In this short video, I'll walk you through the steps needed to establish a solid mental foundation to generate and withdraw money consistently from the financial markets. Trading is not just about making money, it's about building wealth, securing your financial future, and achieving freedom. But to succeed in the markets, you need to be willing to put in the work. Discipline is key when it comes to trading. It's not just about making money, it's about sticking to your plan even when the markets are volatile. Education is essential for every trader. It's not just about memorizing chart patterns. It's about developing a deep understanding of the markets and how they work. Emotional trading is a common mistake that can cost you big time. But the good news is that it's also an opportunity to develop greater self-awareness and discipline. Recognizing your emotions is key to making better trading decisions. By being aware of how you're feeling, you can take control of your trading and make more informed choices. The dangers of trading: a cautionary tale. Trading is a high-stakes game where emotions can run wild and impulsive decisions can lead to disaster. Most traders lose because they want action. They confuse price movement with progress and start making trades without proper analysis. Many beginners make the same mistake. They get caught up in the excitement of the markets and forget to do their due diligence. Trading is not a game of chance, it's a game of skill and knowledge. By taking the time to analyze the markets, you can make informed decisions that increase your chances of success. By getting caught up in your emotions, you're more likely to make impulsive decisions that hurt your trading account. Recognizing your emotions is key to making better trading decisions. By taking the time to manage your emotions, you can stay focused and avoid costly mistakes. Lessons learned: avoiding common trading mistakes. Every trader makes mistakes in their early trading years, but you also have to learn from those mistakes. One cannot become a successful trader overnight. You have to spend countless hours studying, learning from others, and refining your trading skills. Education is key in trading. It's about understanding the markets, developing a solid strategy, and staying disciplined. I have seen many traders make the same mistake I did. They get caught up in the excitement of the markets and forget to do their due diligence. Impulsivity can be deadly in trading. By taking the time to analyze the markets, you can avoid costly mistakes and make more informed decisions. Patience is key in trading. It's not about being lucky, it's about being disciplined and focused on your strategy. The market is always right. A reminder: have you ever heard the phrase, "the market is always right"? This quote emphasizes the importance of humility when it comes to making predictions or decisions about the market. We are not infallible, and our perspectives can often lead to errors. The market is always right. It's a reminder that we should be humble and open-minded when it comes to making decisions about the market. The market doesn't care. A lesson in humility. Have you ever tried to predict the market? You've come up with a theory, applied some logic, and even had confidence in your predictions. But the market doesn't care about any of that. We think we can outsmart the market with our theories and logic, but the truth is the market operates on its own terms, independent of human emotions or intentions. So what can we do instead? We can focus on understanding the market's underlying mechanics and accepting our limitations. That's where humility comes in. The market doesn't care about our predictions or theories. But by accepting this reality and focusing on understanding the market's mechanics, we can start to make better decisions. When we try to force our will on the market, we often end up getting hurt. On the other hand, when we learn to listen to the market signals and adjust our strategies accordingly, we can increase our chances of success. Be willing to adjust your strategy as new information becomes available or as market conditions change. Recognize that you can't predict the market with certainty and be willing to learn from your mistakes. After trading for a while, I realized that trying to fight the market or guess its next move was a losing battle. Instead, I chose to focus on being reactive rather than proactive. By reacting to what's happening in the market, one can focus on managing the risk and adjusting the position size accordingly. This shift in mindset is a hallmark of becoming a successful trader and investor. By embracing the uncertainty and unpredictability of the markets, we can tap into the power of momentum and trend following strategies. By following the market's direction when it's clear, you're more likely to catch profitable trades and minimize unnecessary losses. And by not arguing with the market, you're less likely to make emotional decisions based on fear or greed. Trying to predict market is a flawed approach to trading. Markets are inherently complex and unpredictable, and even the most skilled traders can't consistently move prices in a desired direction. You should focus on more productive pursuits like refining your analysis, managing your risk, and making data-driven decisions. Recognize that trends can change direction at any time, and being aware of potential catalysts for reversals is crucial. This approach is often referred to as trend following strategy, where you focus on capturing the upside potential of a rising market while limiting your exposure to potential losses in a declining market. The simplicity of this rule belies its power and effectiveness. By not overcomplicating your trading decisions with unnecessary analysis or emotional inputs, you're able to stay focused on the big picture and make more informed trading decisions. Buying any asset class simply because of its price or because you like them doesn't necessarily translate to long-term success. Instead, your investment thesis should be rooted in the idea that when a stock or futures goes up on high volume, it's often a sign of underlying strength and momentum. This mindset is essential for traders who want to make informed decisions based on data-driven insights rather than emotions or intuition alone. Buying or adding on to positions in stocks and futures that are already trending upwards is an effective strategy for capturing the energy of momentum and letting the market do the heavy lifting. The strategy involves recognizing high probability scenarios where the price is expected to continue upwards in a particular asset. Understanding market dynamics and recognizing that breakouts can be a powerful signal for long-term success, implying that they have potential for continued growth and upside. By being attuned to these factors, you may be able to identify opportunities for long-term success. If you're holding a position in a stock that's declining, consider selling or reducing your exposure to limit potential losses. This approach emphasizes the importance of risk management and prioritizing caution when markets are uncertain. By being more conservative, you can reduce your exposure to potential losses and preserve capital for more promising opportunities. Riding existing trends can be a great way to make money in the markets, as it allows you to benefit from the momentum of an established trend without having to put in a lot of effort or risk. As long as you're on board with the prevailing market sentiment and trend, you can often ride the wave to success. However, getting too confident or arrogant about one's abilities and try to go against the trend in the market can lead to significant losses. By aligning yourself with the trend, you are less likely to get caught up in emotional biases or impulsive decisions. This involves being patient, disciplined, and willing to ride out the ups and downs of the market until it signals a change. Trading can be a high-stress activity, and that emotional decisions can often lead to poor outcomes. By defining clear entry and exit points, traders can reduce their exposure to potential losses and minimize the impact of unfavorable market movements. By waiting for the market to show you it's time to act, you're essentially allowing the market to dictate your entry point rather than trying to force a trade based on preconceived notions. This approach can help reduce emotional biases and impulsive decisions. A well-defined trading plan ensures that you're following a logical approach to buying and selling rather than reacting impulsively in the excitement of trading. In reality, trading is a highly nuanced activity that requires careful consideration of multiple factors, including market analysis, risk management, and emotional control. To be good at market analysis, you have to learn to identify chart patterns. Support and resistance are fundamental concepts in technical analysis, and they refer to specific price levels where buyers or sellers have historically exhibited strong interest. Support levels are areas where the price has bounced back from a previous low, while resistance levels are areas where the price has struggled to break above. By sitting and watching the price chart for a long time, you're essentially allowing yourself to develop a deeper understanding of the market structure and behavior. Staying focused and avoiding distractions is crucial when waiting for a trade to confirm. This can be a long and challenging process, but it's essential for making informed trading decisions. By paying close attention to price action, you are able to develop a deeper understanding of the market's behavior and identify potential trade opportunities. It's important to confirm from multiple sources before entering a trade. By waiting for a stock or futures contract to break through a level with both volume and strength, you're ensuring that the market is sending a clear signal about its intent and it may continue to rise in price. If the stock or futures refuse to go lower, despite being stuck in a sideways trading range, and finally breaks through resistance, suggests that the market had been building up momentum and interest around this particular price zone. Breaking through resistance is often a sign that the market has finally overcome its initial resistance and is poised for further upward movement. Chasing short-term trades can be a major pitfall in trading as it leads to impulsive decisions and reckless risk-taking. These short-term market fluctuations that are often driven by emotions, speculation, or lack of fundamental understanding of markets. In contrast, waiting for clarity requires patience, discipline, and a deep understanding of the underlying market dynamics. It involves taking a step back, analyzing the bigger picture, and making decisions based on solid fundamentals rather than fleeting momentum. Entering too early in the trade can expose you to randomness, which refers to unpredictable price movements that are often driven by market sentiment, emotions, or unforeseen events. When you enter too early, you may be forced to either ride out the volatility or close the position, potentially losing money due to unexpected price swings. On the other hand, entering too late means missing out on potential profits as the opportunity will likely pass you by. This can be especially true for trend-following strategies, where a delayed entry can result in not capturing the majority of the potential profit. You should have a mindset where you don't try to guess or anticipate the market's movements, but instead allow the market to guide your decisions. By not trying to force your will on the market, you're giving yourself an edge in several ways. You should always wait for the market to prove itself before scaling up and making larger commitments. By adding to your positions when they move in your favor, you're essentially building your trading account over time rather than trying to make quick gains. When a trade is performing well, you should be adding more money to the position in order to increase your potential gains. Conversely, when a trade is no longer working out, you should be willing to cut your losses and move on. By starting small and gradually increasing your position size as the trade works out, you're getting feedback from the market on whether or not your trade idea is correct. And you're not putting all your eggs in one basket, so to speak. You're watching how the trade plays out in real time, which helps build confidence in your strategy. The strategy should be to buy additional shares or contracts if the market continues to show signs of strength. The increase in buying should be in incremental stages, with each additional purchase being contingent on certain conditions being met. This approach can help reduce emotional decision-making and improve your discipline as an investor. Many traders, especially those who are new to the markets or have a relatively small account size, tend to take excessive risk by overcommitting themselves too quickly. This approach can be devastating as it leaves little room for error or unexpected market movements. Many new traders can become enamored with the idea of making quick profits or achieving overnight success. The thrill of the idea can lead traders to act impulsively, ignoring risk management principles and fundamental analysis in the process. You should always match your position size to your risk tolerance. This is a fundamental principle in trading and investing as it ensures that you don't overexpose yourself to potential losses. When adding to your position based on strength of the move, you're taking advantage of opportunity to increase your position size as the trade confirms its direction. By riding the wave of momentum, you can capture more significant gains and reduce potential losses. As your position size grows, so do your potential returns, leading to compound growth over time. In many cases, it's not just about getting into the trade, but also about getting out with a profit or minimizing losses. Exits can be the difference between a profitable trade and a costly mistake. Developing a plan for how to exit trades, including stop losses, take profits, or trailing stops, helps you stay disciplined and avoid emotional decisions. Traders may feel confident in their ability to enter trades at the right time without realizing that they are taking on significant risk by not having a solid exit strategy. Failing to have a clear plan for exiting trades can lead to impulsive decisions, emotional trading, and poor risk management. The price chart can be a powerful indicator of a trend's strength and direction. By watching for patterns such as head and shoulders, triangles, or inverse head and shoulders, you can identify potential reversals. By recognizing when a trend has reached its peak, you can avoid losing money by not continuing to hold on to positions that are likely to decline. By recognizing price action patterns, volume, and momentum, you are able to identify potential reversals and make informed decisions about when to enter or exit trades. By being willing to adjust your approach based on changing market conditions, you're able to adapt to new information and stay ahead of the curve. When traders get emotional or optimistic about a trade, they often start to lose sight of their original goals and risk management strategies. This can lead to a series of poor decisions that ultimately result in significant losses. By not holding on to trades for extended periods, you're reducing your exposure to market fluctuations and minimizing potential losses. By prioritizing your risk management strategy, you are making a deliberate decision to limit your exposure to market fluctuations and protect your capital. By keeping what you earned, you are preserving your wealth and maintaining a solid foundation for future trading success. Closing the trades and walking away with profits keeps traders focused on their trading process and strategy rather than getting caught up in emotional highs or lows. By emphasizing their own financial well-being, traders are less likely to make impulsive decisions based on emotions. By making and planning your own exit decisions, you are demonstrating self-discipline and mental toughness, which are essential for achieving long-term trading success. By tuning into the market's unique rhythms and patterns, you're avoiding the temptation to follow the crowd, and you're able to develop a unique edge that sets you apart from other traders. The market is always changing, and what works one day may not work the next. By listening to the market, you are able to adapt and stay ahead. By understanding your own biases and tendencies is essential for making good trading decisions. By acknowledging the potential for others to sway your opinion and resisting their influence, you're able to develop your own distinct style and strategy. If you get influenced by external factors and ignore market signals, it will ultimately lead to a suboptimal outcome. If you hold on to an asset for too long, waiting for the situation to improve, rather than cutting your losses and moving on to the next trade, you are developing bad habits. Price action is indeed the ultimate truth in markets. It's the only thing that truly matters as it reflects the underlying dynamics and sentiment of the market. By focusing on price action, you're avoiding the noise and distractions of rumors, opinions, and predictions, which can often be misleading or inaccurate. In today's trading environment, it's easy to get caught up in the noise and focus on what others are saying rather than focusing on our own analysis and decision making. In the end, it's not about what you say or how smart you sound, it's about being able to deliver consistent results and make informed trades based on your analysis. Trusting only the market data itself and a markets first mindset where you prioritize understanding market dynamics over external influences or opinions. And avoiding taking advice from others can help you stay focused on your own analysis and decision making. This is the way to maintain independence and avoid getting caught up in the hype or noise of market discussions. Building an edge is all about gaining a competitive advantage over others. It can be developed by understanding of market dynamics, trends, and patterns. Staying informed about market news, analyzing data, and recognizing potential opportunities and risks. Emotions can be a significant obstacle for traders as they can cloud judgment and lead to impulsive decisions. However, by separating emotions from execution of trade, traders can achieve better outcomes over the long term. Trading can be a rational, data-driven activity when executed correctly. However, many traders struggle with managing their emotions, which can lead to impulsive decisions and suboptimal performance. Trading is a journey that requires patience, discipline, and self-awareness. By recognizing the importance of emotional control and making informed decisions, traders can improve their performance and achieve long-term success. Discipline and self-awareness are essential for success. Developing skills to recognize and manage emotions takes time and effort. Emotions create a mental battle, dividing a trader's attention between managing the external market and regulating their internal emotions. Deciphering the complexity of trading with emotions is essential for traders who want to avoid emotional pitfalls. The importance of discipline and rituals in trading is essential for traders who want to improve their performance. Creating a routine that helps stay disciplined and avoid emotional pitfalls. Sticking to a well thought out strategy, even when emotions are trying to sway them. Discipline helps traders stay focused on long term goals. By avoiding impulsive decisions, traders can maintain a clear focus on their objectives. The importance of self-reflection and emotional awareness in trading is essential for anyone who wants to improve their performance. Tracking trades and reviewing performance can help traders identify areas for improvement and refine their strategies. The importance of patience and not trading randomly helps build self-awareness and emotional control. When emotions are trying to impact decision-making, traders can develop greater self-awareness and make more informed decisions. Real profits come from patient, well-planned trades. By taking the time to find high-probability setups, traders can increase their chances of success. Avoiding emotional reactions and sticking to a solid plan is crucial for maintaining a profitable trading edge. Not taking trades on every price movement and sitting on hands is a powerful strategy. By avoiding impulsive trading decisions and not getting in the trades on emotions or biases, traders can avoid making mistakes that could cost them money. Waiting for high probability setups is key, and when in trade, letting the market work in your favor, allowing prices to move in your direction can help traders maximize their profits. Cutting short, well-planned trades for small profits too early can be costly in the long run. Holding on to profitable trades for a longer period can help maximize profits and reduce the impact of market volatility. Holding on to positions is key to maximizing profits. By allowing trades to run their course without intervention, traders can increase their chances of success and greater profits. By setting clear rules and guidelines for entering and exiting trades, traders can avoid impulsive decisions and increase their chances of success. Discipline to wait for the trade to set up is where the fortune lies. By being patient and waiting for the right opportunity to enter or exit a trade, traders can increase their chances of success and avoid costly mistakes. Your discipline to exit a trade is crucial too. By having a well thought out plan for exiting trades, traders can minimize losses and maximize gains. Losses are an opportunity for growth. By not dismissing losses, traders can learn valuable lessons and improve their performance by identifying areas for improvement. By examining losses, traders can gain a deeper understanding of market dynamics and develop more effective strategies. The way traders respond to losses can significantly impact their performance and overall success. Every trader experiences losses, but it's how they handle them that separates those who succeed from those who don't. By learning from losses and adjusting strategies accordingly, traders can develop greater confidence and perseverance. Throughout history, people have always sought to speculate on potential gains, whether it's in finance, real estate, or other markets. Despite advances in knowledge and technology, humans tend to fall into the same patterns of speculation. By grasping the fundamental nature of speculation, investors can better navigate potential pitfalls and make more informed decisions. By adhering to one's own rules and avoiding emotional decisions, traders can maintain a clear head and make better investment choices. While the market may fluctuate unpredictably, a trader's decisions have a significant impact on their overall performance. By regularly reviewing and refining one's strategies, traders can adapt to changing market conditions and improve their overall performance. By relying on analysis and data-driven decision-making, traders can gain a competitive advantage over other investors and avoid impulsive decisions and common pitfalls. When traders have clear rules in place, they can make more informed investment choices by following a well-defined system and can maintain consistency by avoiding impulsive decisions. When traders make decisions based on emotions, they may experience short-term gains but ultimately fail to achieve long-term success. By following a well-defined plan, traders can avoid impulsive decisions and stay focused on their long-term goals. To thrive in the world of trading, one must adopt a specific mindset. This mindset is built on resilience, discipline, and a deep understanding of the game. Follow well-defined trading system and stick to the rules rather than relying on intuition or guesswork. Establish achievable goals, both short-term and long-term. This will help maintain focus and motivation throughout the journey. View failures as opportunities for growth and learning. Focus on improving skills and strategies rather than dwelling on past mistakes. In conclusion, mastering the art of trading requires discipline, focus, and education. By following these principles, hard work, self-awareness, and a willingness to learn, you will be well on your way to achieving financial freedom.